We hear so much about the opportunities to buy distressed assets these days, and everyone from Starwood Capital to BlackRock to former Countrywide executives are raising cash to snap them up on the cheap. But the reality, says our next guest, is that the pickings are mighty slim. For now, anyway. Greg Segall is managing director at Versa Capital Management. He joins us from Philadelphia this morning. Greg, that's the thing that really struck me. With all that we've heard about distressed assets, your firm, in any case, just hasn't found that much to buy. Tell us why.
Well, you know, it's interesting. I think that what you can assume is this year has been a transitional year for asset prices. There was certainly a lot of distressed assets if you're in the liquid markets available. But at the end of the day, if you don't have to sell this year, you weren't going to sell this year in a time when leverage was down and prices were down. So I would tell you that the flow of deals was as heavy as we've ever seen, and we saw plenty of opportunities, but many of the fires were just burning too hot for us to be willing to walk into those buildings.
So the stuff that people are selling is, like you say, burning too hot. It's really totally undesirable. And is that because the banks have been given forbearance effectively? They changed the accounting rules and they're getting the cheap financing from the Fed?
I think all of those things are accurate, and you've got a couple of things at play. If you're a TARP recipient or a major bank and you've essentially got a zero cost of funds from your overseers at the Fed right now, and you've had an effective suspension of mark-to-market accounting, and you've seen asset prices generally recovering over time, why would you move to get rid of assets on your books that create losses and result in further depletion of capital? So I think that the environment in 2009 for lending has been a significant contributor to the slowdown in distressed asset transactions. And at the other end of the spectrum, I would also comment that it's not that there's nothing going on, but the things that are being sold are in such deteriorated shape because they're consuming new cash that even the banks who have plenty of free money don't want to continue to prop them up.
Now, what effect is all the financing that's become, or not the financing, but the fundraising that we've seen going to have on distressed opportunities? I just mentioned Starwood, we've seen BlackRock, we've seen GI, we've seen all kinds of people raise distressed funds. There's tons of money sloshing out around there.
Well, that's certainly true, and I think on this channel last year you would have reported even larger amounts that were raised in anticipation of things like the hung LBO bridge loans and so on. So enormous headline dollars were raised for the category, but I'm not sure how successfully it was deployed. And there have been pretty widespread reports that plenty of otherwise very intelligent players got caught catching falling knives, as it were.
Okay, now tell us what 2010 might look like. You've got all that money available, but we hear about the pending disaster in commercial real estate. You think the environment's going to get better for people like you, which kind of means that it might get worse for the rest of us.
Well, yes, we absolutely do. You know, for several years we were asked when was the credit boom going to end, and we get a similar question now, when's the credit bust going to end? And, you know, we bought a lot of companies that were in a lot of trouble in an otherwise healthy economy, so it's counterintuitive to think that there won't be plenty of troubled companies available in a troubled economy. 2010, for a variety of reasons, is shaping up to be, we think, really a field of dreams for distressed control investors like us. Among things, I think you've also been widely reporting that most, if not all, of the major banks have been doing everything they can to get out from under their TARP oversight. And we think that that represents an important psychological change for the financial institutions. Just as there's been forbearance on residential real estate and home mortgages, the phenomena of what we call amend, extend, and pretend by banks in terms of just kicking down the road the problems with their borrowers is likelier to come home next year.
Greg, I'm afraid we've run out of time. I do want to thank you to Greg Segall of Versa Capital Management on distressed assets.